5, 4, 3, 2, 1.
Welcome to this week's edition of the EUVC Lowdown, the show that wraps up the week in European venture with some of the key people making the headlines. Unfortunately, those key people making the headlines this week were unavailable, so we have this lovely lot for today. I'd like to welcome Dennis Vukovic. I'm not going to get it right every time, Dennis. I'm going to try it. The GP of Very Early Ventures. Scott Newton, managing partner of Thinking Dimensions. Of course, Dan Bauer from Superseed is here with us, as well as the EUVC team, David and Andreas. I'm your host, Kathy White, founder of CEW Communications. And before we get into the only topic that we're going to talk about today, and you'll realize why I said none of the key people making the headlines are with us, I'm going to ask Dennis to just briefly introduce yourself before turning to Scott. So welcome, Dennis, to the show.
Thank you, Katie. Hello. Yeah, my name's Dennis Vukovic. I don't mind if you mispronounce my name. Happens constantly, so I got used to it. I'm the GP and founding partner of Very Early Ventures. We're a crypto native fund investing in, early stage projects, also buying tokens on public markets. We are currently having our first close. That's it. Originally, I have a background in machine learning. Actually, that's how I met all the other co-founders. Matthew and myself were doing a PhD at ETH Zurich. Jan was writing his thesis with us, or more precisely with Matthew. And eventually, a few years later, we came together to launch the fund.
Amazing, thank you. And I feel like we did a fair trade then, because you also mispronounced my name. This happens all of the time in Europe. Kathy becomes Katie, Catty, all of these other lovely names. No, it's fine, don't worry. I actually quite like it. It makes me sound much more exotic than I actually am. Scott, welcome to the show. It'd be great to hear more about Thinking Dimensions as well.
Good morning, Scott Newton, based in Northeast Italy, the Veneto region. I'm managing partner at Thinking Dimensions. I work in strategy and M&A, and a lot of our focus is on digital transformation. Part of that, of course, involves the crypto space. More importantly, from our perspective, blockchain and smart contracts. And it's great to be on the show this morning. Thank you.
Awesome, welcome. We're going to be exchanging Italian tips after the show, because I'm going to need some more ideas for my next trip to Italy. On that note, though, I'm going to bring us into the only topic that we're talking about today. I think Dennis's introduction nicely gives a little bit of a hint, but of course this week we are talking about FTX. So by now, we're sure most people will be well aware of the story, but as a brief recap, cryptocurrency exchange FTX, one of the world's largest exchanges for cryptocurrency, enabled its users to do a variety of different things, from connecting their wallets, trading, exchanging digital currencies, buying and selling NFTs. Well, it collapsed. Founded only in 2019 by a name I'm sure will have a Netflix film dedicated to him within a year, Sam Bankman-Fried, the firm attracted the biggest investors in Silicon Valley, and last week it declared bankruptcy and Bankman-Fried resigned. Earlier this morning, I caught the Strictly VC newsletter, and they just captured a little bit from the incoming CEO, John J. Ray. He has previously helped oversee some of the biggest bankruptcies, including Enron. And he stated in a filing to the Federal Bankruptcy Court that he has never seen anything as bad in 40 years of restructuring firms. From compromised systems integrity and faulty regulatory oversight abroad to the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals, this situation is unprecedented. Now, I am not an expert at all. I will be putting in my 2 cents later when it comes to the comms side of all of this. So Dennis, as one of the more knowledgeable crypto guys that we know, it would be amazing if you could just start, by answering the big question: what the hell is going on in crypto land now?
Oh my God. Okay. That's a very good question. It's a question we're all trying to answer. You gave a very good summary, and a few points that are currently, the most discussed, like your example with the former, Enron, who supervised the Enron process. So obviously that's telling you how big of a, can we swear on this show? Or
Absolutely.
Yeah, like how big of a shit show, clusterfuck, as people say. This is, frankly, it's also quite embarrassing what happened. The degree of deception and fraud probably went so far that everyone was, basically assuming it's impossible to go to that degree of deception and fraud. Long story short, as I mentioned, your summary was great. FTX and probably Alameda Research together used customer deposits, defrauded them, and lost money. Somehow, that's the thing we don't know yet, how it actually happened. There's a lot of speculation there. People used to assume that Alameda Research had a great advantage on FTX. which would allow them to print money. Somehow that apparently did not happen. And yeah, we don't know yet how that actually happened, but I'm hopeful we'll find out. You mentioned there will be probably Netflix movies made about this. Interestingly, probably you've heard Michael Lewis was already spending quite some time with SBF, so Sam Bankman-Fried, the past 6 months, I think. So yeah, I'm very curious and excited to see what's what happened there, or what information he's willing or able to share with us.
I'd love to hear you try and put this in the context of the bigger deal, which is all of crypto, right? Because right now everyone is looking at FTX and we're hearing about FTX, but what does it mean? What does it say about the state of crypto? Not only FTX, and what does it say about the future? Where are we? Why was this even possible on, in crypto land?
Well, hold on two secs, Andreas. I mean, I think, and I have to use the word allegedly, but I think we know what went wrong. And I think it's also fair to say that we know that it could have been any business. If SBF was in any financial, and I'm not a crypto fan, I have to put my stall out now. I'm a very not crypto fan, but I think it's fair to say that any financial business, had he behaved in the same way, and yes, it should have had governance, and there should have been some kind of adult at the tiller. This is not necessarily a crypto problem. What he was doing, he was shilling money between two businesses, lending himself money through his R&D company, Alameda, whatever it was, as a token to then leverage and borrow and then refund FTX. It was a almost Ponzi scheme, allegedly. So he did, but that could have happened in that didn't need crypto to do that. I mean, anybody. I mean, obviously, who's the guy that killed himself in jail? The main Ponzi guy. And if you wanted to do this, you could have done this in any financial services. I think we have to just make sure we make that distinction.
I'm just going to jump in, and then Scott, I'm going to bring you in. I know you wanted to say something on this, but one thing I caught today, and I need to sign up and register to the information so I can read the whole article later. But
I'm happy to share my account open.
Thank you. We'll do that. I'll share some other accounts for other things later.
They haven't replied to my request for them to sponsor me, so for that reason, I'm now giving my account to everyone.
Okay, fine. We'll do that. But let's really support the media. It's sad this week. Protocol shut down this week, which is sad. I was just going to mention that he also put money back into a couple of the funds that invested in FTX. So through the other side of it, he went in and put hundreds of millions or something. It might not be hundreds of millions, I'll check the numbers, but back into Sequoia. So this Ponzi scheme, lending, borrowing, shifting, it all gets very incestuous and messy. Scott?
Yeah, you're segueing into my point, which is, hang on a minute. These are some of the largest and most sophisticated investors in the world. Sequoia is not their first day at the rodeo, nor...
Let's use Dan's word again here, allegedly.
Yes. An Ontario Teachers' Pension Fund is allocating billions around the world, and they're normally known to have quite a strict due diligence process. And so my question is, and having worked on some of these deals, not like the term sheet that SBF was using, I've never seen anything like that, but there is some basic due diligence done. And one of the first questions every accountant asks is, can you show me the interrelated companies and the interrelated transactions? And if you look at the bankruptcy filing, which was made public in Delaware last night, you can download it online. I've never read anything like this. I mean, it makes Enron look like the ethics company of the year, which is, to me, there's a bigger question to be asked here in terms of how were people allocating money to this without asking basic questions.
There was the DDPs, there was the investors, and then there was the running of the company. So they're two very distinct time phases. So I think conflating the Canadian Teachers' Pension Fund into how the business is run, and there are two very distinct challenges. That there was no governance.
Do you think so, Dan? Do you think so? Because it's not like they raised billions of dollars years ago and then started being, I won't say, or maybe corrupt is the right word to say here. It's it's been going on during those fundraisers. But I'd maybe ask you, Dennis, to come in on this, because I think you're probably the one with the closest eye to both timelines, but also to understanding, the structure of what's actually going on here.
I think you need to distinguish between the early and the late stage investors. I don't think early stage investors could have known. I don't necessarily think that they missed very important steps in the DD. Like, maybe they did, but I can't. I can't say with very high certainty that was the case. With the later stage investors, I do think that there should have been, checks conducted that maybe or probably might not have happened. So yeah, that does, I think, one of the big losers, let's say, in this whole fiasco, both reputationally and financially, are certainly these late stage funds that I think last year invested at, or I'm not sure if it was last year or this year, at a like multi-billion-dollar valuation.
On that note, no, but I'll say something then, because I'm looking here on the Sequoia note to their LPs, where they then both argue that, well, it's only a small position in our fund, so who really cares? We're not down on the fund on overall levels. It's only 200 million or so that we flushed out in the toilet, so who cares? When I saw that, I kind of thought, yes, well, from a portfolio construction level, you're completely right, but it's still 200 million. It's still what most people would say, well, shouldn't you have known better? Shouldn't you have been able to see this? Dennis, what's your take there? Because you said you distinguish between early stage and late stage, and I know Sequoia likes to think of themselves as seed investors, but you don't put 200 million in a seed investment.
I totally agree. I think at these later rounds, whatever you call them, certainly not seed. Was it a Series A? Was it a Series B? I don't know. I think it was like maybe the third or fourth time that they raised capital. At that point in time, I think there's like, let's say, points from a corporate governance perspective, like having a CFO, which apparently FTX didn't have as an exchange, or having a board, which Chamath now likes to claim that that was a big red flag for him. I think these are like best practices that probably should have been set up that were not.
No, it's just really quickly, I know David also wants to add something here, but it's just the number of red flags. Like, what were they on?
Adderall, I think.
It's money, Kathy, money. If your business is printing money quite literally, you don't look so hard. You need the returns, the greed. The red mist of greed takes over. I mean, what the freak? Well, I mean, it's the VC way, he says.
I'm just waiting for the play on Wolf of Wall Street, and it's going to be something.
I hate being the boring guy here, right? Because when we're talking about it's just one thing in the portfolio, it's just money, whatnot. And I hate being the boring guy of bringing in the regulatory kind of piece into it, because at the end of the day, there was a bunch of people that lost money, right? And so I think it's really interesting to talk about portfolio and was it a good or a bad investment? Should I have done DD or not? But at the end of the day, some people will literally fucked by what was happening, right? And so I think the interesting question as well, and I'd love to hear everyone kind of comment on it, because VCs notoriously, we hate regulations, right? Is how do we think about the regulatory side towards crypto in the light of what just happened, right? Because that is, for me, what is the real problem. It's not that Sequoia lost whatever million in their portfolio and whatever. Honestly, I don't care. Sequoia will be fine, right? I do worry about that. I don't know how many people that lost money, and probably money that they shouldn't have allocated or put it into FTX. I don't know.
Well, hang on though, because I mean, in CoinGeek, if you look at Gavin Lewis, the reporter, last November, he was writing articles saying that there was something really wrong, and that Alameda Research couldn't be doing what they said they were doing. So I wrote to him, he wrote back to me, he said, yeah, this is a greed story, but we understand there's pressure on funds to have returns, but not asking for a board seat, for example, not even asking for a financial statement, because if you don't have a CFO, presumably you can't even present a financial statement. Those seem like pretty basic red flags. They're not, we're not talking about deep forensic due diligence, just level one questions in terms of controls and allocation of money. Many
VCs don't take a board seat, famously don't take a board seat, but that has nothing to do with governance and weights and measures and balances. But it's very common for VCs to not take a board seat, just for the record. Yeah, that's a good point, Dan. I've seen that not all VCs take a board seat, but some do. And Sequoia has a number of board positions, for example. This wouldn't be the first time. So I know in terms of Sequoia, 200 million is not a lot of money for them, but as David's noting, a lot of small investors got burned on this, and we actually don't even know how big this is. If you look at the bankruptcy filing, they wrote it's somewhere between 10 billion and 50 billion. And I thought, wow, that's a pretty big range that we're looking at here. Yeah, no, I think that's fair. I think from Sequoia's point of view, and I don't think they were the only fish in the pond, the choice would have been from SBF, you take this deal on my terms or you don't get the deal. So that's the challenge that they would have had, is do we want this deal? And you saw they're all wetting their pants over it. Do we want this deal? In which case there is no board seat, structure on it. But the guy is printing money. Of course, when you're dealing with an unregulated financial tool like a crypto coin, which nobody's really got a handle on, and nobody really, I don't think, would have seen how he was Ponziing behind the scenes, or maybe it would have been taken a blind eye to, because it will all be okay at the end of the day. That's the risk that you take, and that's the risk at the Wild West and the new frontier. So, and they got bitten, but I think, I think it was 0.25 of AUM, so, or 0.25% of that fund. I think. I mean, it's negligible to minimal. So that's why they were willing. And then the poor schmucks that then follow Sequoia and Excel and Andreessen. I mean, Andreessen's crypto portfolio. I mean, goodness, what levels they're at. They must be. I mean, I don't even know what kind of doldrums they're going to be in at the end of the day. Anyway, so that's my mini rant, and I've got more to come.
Really quickly, because Dan did say this, right? It's not just Sequoia. We're ripping into Sequoia quite a lot here. So that's a reminder, as I pulled this from Twitter.
No, but I didn't mean it at all. My question / comment, I didn't mean it at all directed at Sequoia or any investor specific. I actually mean on the underlying responsibility that all VCs actually have, especially investing in certain areas, right? So when a VC is investing in drug development, well, there are fucking high responsibilities that you have to adhere to, right? Well, crypto, you're actually, I believe that you should also, because you're actually at the end of the day dealing in a very emerging technology that very few people understand, and it's dealing with people's money, right?
But there's no way to do it, David. There is no regulatory oversight. They don't know whether it's a security, they don't know whether it's an asset, they don't know whether it's a currency. There is, I mean, I guess the Americans have taken a semi-step forwards, but there is nobody. There is no, there are no weights and measures. I don't know where do you start?
And that was actually the question that I wanted to ask to Dennis and Scott. Your reflections on, and if we start with you, Dennis, your reflections on the state of regulation and where we headed, because Tip, I know of a crypto VC who likes to call himself an anarchist, as an example. So they don't particularly love regulation. But then we had, Koschler go out the other day and say, and put a big piece about, well, we need regulation for this to not happen, and we need regulation for the good players, the good actors, to be able to actually do something meaningful in crypto. But Dennis, with that, I'll kick it to you. Where are we?
Well, it's a super good question. And probably not that easy to answer. Like, on the one hand side, you could say, of course, this is an issue that would have been solved with more regulation, like with more transparency and better Chinese walls between the different little subdivisions that FTX and Alameda had. So yeah, maybe more regulation would have helped here. At the same time, you have this problem that SBF was like the chief lobbying person in Washington, DC, and donating quite a lot of money to politicians and regulators, legislators, all of them. He did have a proposed a bill that he was supporting. I don't remember what it was called, like DCP something, and that is now considered to be dead. Also, like, that's probably the weirdest part of the story, that he had the audacity to lobby for more regulation while doing all of these shady things. Well, so that is basically regarding this regulation path. I don't see the clear path forward, because there was this dominant path that is now being a bit, that is suffering probably quite a lot from the reputational damage. And also initially you could have said that the suggestions, propositions, whatever in the bill are not that great and are favoring like centralized entities instead of the whole DeFi stuff, which we haven't talked about at all yet. So basically, if you look at all the protocols, at all the applications that perform small little functions like borrowing or lending, the AMMs, so like, let's say the market makers, all of these performed well. None of them failed, at least let's say on Ethereum. There's a few projects on, let's say on Solana, that didn't do that great, but for other reasons. I'm losing myself in details now, sorry. Long story short, probably regulation is one approach, but I think on a first principles basis, I think the idea is to get transparency and to get the Chinese walls that I mentioned, and regulation is one approach to get that, and the other approach is the DeFi approach, the modular code approach. The only issue there that remains to be solved is the whole like KYC, AML, money laundering, maybe the hacks as well, but that's probably a different topic.
Scott, I'd love to bring you in on this because you know a bit about policy and regulation of this space as well. So what is your take?
Yeah, I'd say there's 2 points here. One, crypto or any type of currency or economy is based on trust. And so if we don't have that trust, then we come into the kind of Zimbabwe scenario where you have you're printing notes of 10 billion that tomorrow are worthless. So we need this basic trust for the economy to work. From a regulator or from even a basic economy and societal point of view, we know that smart contracts and that DeFi bring the opportunity to develop society and to address some issues with equality. But that's not going to happen if there's not trust. So the governments, policymakers are going to play a role in setting some clear rules on, what are acceptable business practices and what are not. And part of that can be an education piece, and part of that can be a regulatory piece in terms of there are very clear laws, even in the Bahamas, about how you can use customer deposits. That's not something that's being questioned. The question here is how someone could build allegedly a backdoor in Excel that allegedly transferred $8 billion from one entity to another entity without any advisement to anyone, because that's a pretty difficult transaction to understand. And without getting into AML, I mean, how do you even explain that to your bank? What actually happened? That would be the question.
So to our audience, I just want to bring their attention to what's going on in the chat, because in our chat, Dan first writes, crypto is based in greed, not trust. And then Kathy says that should be on a t-shirt. And then Dennis disappears from the camera for a second and brings this t-shirt that says, "Oh fuck, compliant." Dennis, tell us a bit of what's going on in your t-shirt.
It's a bit it's possibly hard to understand if you just hear it, because it says "oh fuck" as in OHFUCK, right? But that also does sound like OFAC, which is the US Office of I don't know, it's basically the guys that do the sanction lists. That's the OFAC and
Foreign Assets Control.
So do we need to say it, Scott? Scott, can you do me a favor? Can you just say "oh fuck" but with your accent?
Oh fuck, compliant.
Thank you.
Small story there. We have AlphaQ in Europe as a big fund of fund. And when I first looked up their name, I had a difficult time finding them, because on the Urban Tech Dictionary, AlphaQ means "I'll fuck you." so all the times we talk about that kind of thing in names, I always think, well, AlphaQ turned out not to be the best names after all. But Scott, take us back into the conversation around compliance and where you see us heading, because I thought it was interesting to see the article from Goshila arguing for more regulation. Do you think that's the path forward, or do you think that it lies just as well in a DeFi structure as kind of what I think I heard Dennis saying?
Yeah, my answer is it's both. I think today crypto is kind of at that 1999 point of the internet, where all these companies that were quite strange and had unworkable business models crashed, and there were many articles saying the internet's a scam and this is going away, and we know today the internet's created tremendous value. I think we're at the same inflection point with crypto, and there will need to be some basic regulation to protect investors, and at the same time we have to be really, really aware of how this is going, what the implications are globally of this, because this isn't impacting one country or one investor group. This will change some basics of the economy and of policymaking, and as a result of that, we need to be prepared and to confront that, understanding what those implications are.
That is the perfect segue to kick it to our crypto native, who's building a fund for crypto and blockchain and so on, because Dennis, I am sure that this is the vision that is what's making you gravitate to crypto. So tell us a bit about that.
That is what or why we gravitate towards crypto. I think, frankly, we are of the belief that this is the most interesting, most disruptive possibly industry. Unfortunately, that does usually come hand in hand with fraudsters and scammers. It's unfortunate, but yeah, probably it's also these most volatile and riskiest industries that hopefully bring the best, highest possible, well, not just returns, but also potential, as in, change. For me, it's still one of the most magical feelings when interacting with DeFi protocols. Sometimes it's also scary when you send actual money from A to B when you interact with the protocols. But it's beautiful, it's fun, and we have the belief it's the future. It will probably include some centralized players, probably some lenders will be back or some new ones will arise. It will include centralized and regulated exchanges, but we're more interested in the decentralized, the blockchain native side. And yeah, that's the type of companies that we are supporting and we want to continue to support. We think if you're like patient enough, you have a longer time frame, 5, 6, 7 years, it should pay out, and we will probably see huge changes, improvements, and yeah, new applications that people will actually use.
I just want to just very quickly mention two things before we close off. I think it's very important that we distinguish between coins and crypto, because they're two very different things. There's a whole raft of technologies that they're gonna be extremely useful. My personal take that I'm putting on the table now with my crystal ball and predicting is that coins will be regulated into insignificance. They will not do and be what we think they are today. The Wild West is over, and the FTX has accelerated that journey and will continue to push for more regulation. But regulation will be the end of coins as we know it. I'm just going to leave a steaming turd on the table.
Always good to end on a steaming turd.
Thank you for that image there. I truly appreciate it. And my Friday will be better now.
You were so close to end on the high note of the future of crypto and everything, and how it'll be able to change the world, and we'll no longer have starving babies anywhere. And now instead we end with a steaming turd on the table. Thanks, Dan.
On that note, that's it for today, folks. Make sure to check out the EUVC Lowdown newsletter. I'm going to be adding a little section in there where I'm going to be having a lot of fun dissecting the 10,000 word plus blog that Sequoia wrote on FTX, which mysteriously got taken down in the last couple of weeks and reads like, and excuse my language, we're going to make it worse. So this show needs to come with a warning, but it reads like a circle jerk. So we'll be talking about that in the newsletter, but you can also follow us on LinkedIn, where we'll continue the conversation and also post the latest funds that have raised, our Who's Hiring section, together with a whole lot of GIFs, memes, and emojis. And as promised, each week we will continue to try our best to entertain you, and maybe we'll put a warning on the show for next week. Thanks all.